Good day, Junior Tickies. I'm Mrs. Brimacombe. In this activity, we are going to focus on financial risk and gearing. When we look at our financial risk and gearing, we ask the following questions. What is our financial risk? Are we reliant on own capital or borrowed capital? Should we rather pay off our debt? What is our return on capital employed compared to the cost of borrowing money? So the two financial indicators that we use is the debt equity ratio and the return on total capital employed. Do not confuse this financial risk and gearing indicators with solvency. Solvency means, is the company solvent or the business solvent? In other words, does our total assets exceed our total liabilities? Here we're talking at our financial risk. Are we reliant on own capital or borrowed capital? When we look at the debt equity ratio, this is my non-current liabilities divided by the shareholders' equity. Again, the shareholders' equity consists out of the ordinary share capital plus the retained income note. This must always be expressed in a ratio, and it's always 2:1. When we're commenting on this, we say, for example, if it's 0.7 to 1, for every 1 rand of capital invested by the shareholders, 70 cents was raised through long-term loans. A low ratio will indicate that the business should be able to obtain additional loans. But if we have a high ratio, this indicates that the business is more reliant on borrowed capital than own capital and should rather consider other options to obtain capital. Remember, capital is we need money. What is our options? We can either borrow money or we can sell shares. When we look at our return on total capital employed, very important, it's my net profit before tax plus the interest on loan. And then we look at our average shareholders' equity and our average non-current liabilities. Again, we need capital. What is our options? We can either borrow money or we look at selling shares, retained funds. And this is why these two is included into this calculation. So when we compare the return on total capital employed, it's always compared to the interest on loan. Do not confuse the return on total capital employed with the return on shareholders' equity. Return on shareholders' equity is compared to the interest on fixed deposit. Return on total capital employed is the percentage interest on loan. So if our interest on loan, and we compare it to the return on total capital employed, if our return on total capital employed is higher than the interest on loan, this means that we are positively geared. But as soon as the return on total capital employed is lower than the percentage interest on loan, this means that we are negatively geared. This is very important to remember. Looking at the activity, you are presented with the financial information of Tar Blue Limited for the year ended 28 February 2022. The company has an authorized share capital of 3 million ordinary shares. So we need to answer the following questions and we need to look at the information given. They provided us with an extract from the financial statements and with financial indicators. To calculate the debt equity ratio, we need to take the non-current liabilities divided by the shareholders' equity. So this means that we're going to take 380,000 divided by 1,650,000. Again, your answer is always 2:1. Question number 2, calculate the return on total capital employed on 28 February 2022. Remember, it's your net profit before tax plus interest on loan. So they provided you with the net profit before income tax, and they provided you with the interest expense. So we simply add the two together, divided by the average shareholders' equity and non-current liabilities. So when we're commenting now on this, question number 3, the directors of Tableau Limited want to take out a loan of 800,000. So they are looking at financing the business through borrowing 800,000. Would you advise them to take out the loan? Quote 2 financial indicators that are relevant. So when you see this type of question and you see something about additional loan, should we take it out or not, and you have to quote 2 financial indicators, we always use the debt equity ratio and the total return on capital employed. So if we look at the financial indicator, quote the financial indicator with the figures, indicate the trend. So the debt equity ratio improved from 0.4 to 1 to 0.23 to 1 in 2022. Again, make sure that you use your answer which you have calculated and comment on that. The return on total capital employed improved or increased from 25.9% to 35.5%. So now when we're commenting on the debt equity ratio, are we reliant on own capital or borrowed capital? The 0.23 to 1 indicates a low financial risk. The company is more reliant on own capital than borrowed capital. If we look at the return on total capital employed, it's always compared to the interest rate on loan. So here, if I compare the return on total capital employed, it is higher than the interest rate. This means we are positively geared. Now we can also look at it from another perspective and we can say, right, what happens if we now borrow the 800,000? How would this change our debt equity ratio? So if we calculate borrowing an additional 800,000, our debt equity ratio will now increase from 0.23 to 1 to 0.72 to 1. We would still be more reliant on own capital than borrowed capital. The directors would be able to afford to take out the additional loan. And we are positively geared, so the conditions are favorable for us to borrow an additional 800,000. So when you're looking at this question, before you say yes or no, first look at the financial indicators, comment on that, and then indicate yes or no. In this case, the answer is most definitely yes. We have now looked at all the financial indicators individually. So the next activities that we are going to focus on is on a combined activity where we look at comparing one year to another, and then we're going to look at what happens if we need to compare financial indicators with one company to another. I hope you have a wonderful day. I want to leave you with this quote: you are capable of more than you know.